In today's show, we have a look at how an already successful property investor, Pete Wargent, had to change his property investment strategy because of the world of finance changing.
Are you interested in property investing, success or money? Well, you're in the right place. This is the Michael Yardney podcast, where each week you'll learn a number of new ideas regarding success, property investment and money in 20 minutes or less. Our show is brought to you by Metropole, who specialise in helping you grow, protect and pass on your wealth through strategic property advice. Now here's your host, Michael Yardney, who has once again been voted Australia's leading property investment advisor. That's the fourth time he's won a similar award in the last 6 years.
In previous episodes of this podcast, we've discussed how our property markets are changing, and I've explained some of my thoughts about what we need to do differently at this stage of the property cycle. Recently, in Brisbane, Pam and I caught up with Pete Wargent and his wife. Pete is one of the sharpest young minds in economics and property in Australia at the moment, and over brunch we were talking about property and how his strategy has changed over the last little while based on what's happening in the world. And I said, hey, this is a great topic for a podcast. Let's get together, and that's what we're going to play today. Before I do, I want to say welcome to all the new listeners, because every week we get hundreds of new listeners. I can see it as our rankings on iTunes keep going up. And welcome back to all the existing regulars who enjoy my chat every week. So today we're going to talk a bit about how our property markets are changing as they've moved on to the next phase of the cycle. We're going to talk a bit about how finance has changed, how these things are going to affect different segments of the market, which ones you should avoid and which ones you should still be looking at. And Pete's going to share with me what he's had to do differently, how he's had to change his strategy slightly, how the end game is different, how my philosophy on living off equity has had to be tweaked. It's a great show, lots of information, so let's have a listen what Pete had to say when I put him on the spot. The world of property has changed. The world of finance has changed. Has your investment strategy changed in the past 2 years? That's the question I'm going to ask of Pete Wargent, property analyst and one of the sharpest young minds in economics in Australia today, and somebody I'm proud to call a good friend. Welcome, Pete.
Pleasure to be here, Michael.
Of course, a lot of this has to do with APRA and its macro-prudential controls changing banks' lending criteria. So maybe we should start with that, and then we can dig back into how it has affected you and me as property investors. So let's look at who is APRA, what have they been doing, and what are these macro-prudential controls we've been talking about?
Okay, well, macro-prudential is quite a long and fancy word for something that actually isn't really a new thing. It's really just regulations to mitigate risk in financial markets. So they're always underway to some extent or other. But APRA is the market regulator in Australia, and they have now been tackling some of the excesses in the mortgage market in particular. So we've had, as you know, lots of investors, a high level of interest-only loans and quite high household debt in global terms, and also a lot of Chinese investment. So it's, I guess, what we used to call in the old money a bit of a credit squeeze. But yeah, that's it. It's regulations tackling some of the risks in the mortgage market.
Well, we know that property markets move in cycles, and I've been long enough around to invest through various cycles, and every cycle I've invested in has stopped because of finance. Sometimes it was because of credit squeeze, as you said, and then Paul Keating loosened, deregulated finance, and then it was higher interest rates. But this time round, our regulators were concerned that we may be heading into a boom. Now, whether that was true or not is another matter. They were also concerned about the high level of speculation and debt taken on. So it was really way back in 2014, now over 4 years ago, that these changes started to occur. How has it impacted the mortgage markets?
Yes, there's a lot of stuff going on behind the scenes that probably isn't seen by you and I, but I guess how this is experienced by most people in the market is the changes to serviceability measures. So I think regardless of what happens to the cash rate by the Reserve Bank going forward, lenders are now going to stress test mortgage applications at above 7%. And banks have had to slow their level of investment lending below certain imposed caps, which is probably no bad thing. As you said, it's taking some of that speculative froth out of the market. But there's also some big changes to interest-only loans. So we're often seeing higher mortgage rates on those products and lower rates on principal and interest mortgages to try and encourage people to switch across and some more people to pay down debt. So it's become a bit harder for some people to roll over their interest-only loans. So it won't have any impact on anyone that's managing their cash flows sensibly, but just at the macro level, more people will now be paying down debt, which is no bad thing.
Sure. So just to help understand the concept of stress testing, as you said at the beginning, when banks are lending you money, they're wanting to make sure now that you can pay if interest rates go up, but they may not, and if you have to pay principal interest, even if you won't need to for the loan. And that's making the banks more secure. I remember before the global financial crisis, Pete, you could have cash flow mortgages. You could not have to low doc mortgages, no doc mortgages. You could just get a loan by signing something online. And we could have gone down the same route as the United States with a major crisis in our banking system. But all this has made our banking system one of the more secure systems in the world.
Yeah, that's right. I mean, it's a little bit scary to look back. And as you know, being an Englishman, I've seen it in two countries. But if you look back to before the financial crisis, lending was very freely available. You could get loans at very high multiples of income. And as you said, quite often 100% mortgages. And probably there wasn't the same level of control that there is today. Now, the good news is Australia came through that period, relatively speaking, unscathed. But in recent years, mortgage applications are much more tightly controlled. But that's got to be a good thing for the strength of the financial system.
So APRA has introduced restrictions on the banks, how fast they can grow, which if I was a business, I wouldn't like. But if the regulator says that, they've got to do that. What sort of loans they can get, how they assess serviceability. What do you think this means for our housing markets, and which areas are going to be the worst impacted?
Well, the ABS put out its figures yesterday showing that the housing market overall is now worth almost $7 trillion. Mortgage debt's about 1.7. So less than 25% LVR, if you like, loan to value ratio. So in other words, we have more equity in our homes than at any time in history. And I suppose household net worth is about $10 trillion. So wow. However, the flow of new credit into the market will probably be limited to about what it's doing now. So it's difficult to generalize, but I would say the markets where single salary earners are driving the market will be hit because serviceability will fall for blue-collar employees. But there'll always be some outperformers in any market. So I personally would say that those will be properties with genuine scarcity value and desirability, and those markets that are driven by dual income households, business owners, the affluent or aspirational professionals, and particularly in Australia anyway, intergenerational wealth, because we don't have the death duties here that other countries have. So there'll still be some impact in those markets, but it'll be less acute. So to me, that means that it's the dress circle or the best seats in town.
Some areas are going to be impacted more than others, and it will really be related to how the banks see you as a serviceability risk. So those areas with higher disposable income or multiple income households are likely to do better than the blue collar areas or the regional areas. And I guess that's also partly, Pete, because we know that wages growth isn't high in general in Australia, and those blue collar areas are really struggling with wages growth. The cost of living is going up higher than that, and the banks are recognising that, Pete.
Yeah, that's right. Well, I mean, we've been generalising so far, but let's take a specific example. As you know, I do a lot of work with international investors, not directly in property, but they're interested in the housing market. But take a look at Western Sydney as an example. It's had an absolutely amazing run in terms of prices since 2012. But now we've got to the stage where median household incomes in some of those outer western suburbs are $50,000-$60,000, and yet the median house price is many times, above 10 times that ratio, and just simply not sustainable from a salary employee perspective. We had lots of investors in those markets because people were trying to get a foothold on the ladder, but those markets, they've had a great run, but they're clearly going to have a downturn. A lot of people don't like to hear that, but that's inevitable. But that said, we've been looking around the eastern suburbs of Sydney in recent weeks, and it's still very difficult to get good properties because the clearance rates at auctions are still tracking at nearly 80%. There's a lot of people with more equity than ever before. So, it's a bit of a dichotomy, but the different markets are doing different things now.
Well, I love the old saying that a rising tide lifts all ships, and that's what happened in a lot of our property markets, especially the booming markets of Melbourne and Sydney. And then once the tide goes out, you see who's swimming naked. And by that, I mean those who haven't had a strategy, who haven't bought investment-grade properties. People often talk about the ripple effect where when it started in the centre of Sydney, in the centre of Melbourne, in the centre of Brisbane, and then as those areas did well, the growth and price values rippled out. But it's now almost a reverse ripple effect where the inner, more affluent, the old money belt, as you said, areas there where there's intergenerational wealth, they're still doing okay. But the ripples coming in and the outer suburbs are the ones likely to suffer a bit more, Pete.
Yeah, that's it. And it just comes down to the old thing between, is it time in the market or timing the market? And then don't get me wrong, if people got into those Mount Druitt type markets or St Mary's or Penrith in 2012, fantastic timing and amazing results. But it's human nature is to think that when things are going great, they will always continue to do so. But of course, there comes a point where valuations are too stretched, and that's arguably what we'll see over the next year or two. That's my opinion anyway.
Oh, I'd agree with you, but that's what history has shown. So while the inner suburbs are still doing well, the high end of the inner suburbs are not doing as well either. So you don't need your $7 million trophy home in Rose Bay when your $5 million home will work as well. And discretionary markets such as holiday locations, so the Central Coast, the Gold Coast, the Bellarine Peninsula in Victoria, those areas are not as likely to do well when things are tighter with finance, but areas where people are still getting married, still getting divorced, still having babies, maybe not in that order, they've still got jobs, they're moving on in their life, they're upgrading, they're likely to still perform reasonably well.
Yeah, and that's what we're seeing. It's for the areas where supply is constrained and where there's a lot of people wanting to live close to the beach, close to the city. For the right type of property, there's still a heck of a lot of demand, but it's just shifting a bit as well. So the investors are finding it a little bit harder to get finance in some cases. So that's taken some of the froth out of the market. But look at some of the home loan rates that are being bandied around now in the 3% range, 3 to 4%. So the type of buyer is changing at the margin a bit, but the level of demand is still very high.
The banks are back to lending again, Pete. Like recently, the big four banks have opened their doors again and they're encouraging investors. And it seems like the level of interest-only loans is now well within APRA's regulated proportions. So I believe that you can go into almost any bank and get an interest-only loan if you meet their serviceability criteria, Pete.
Yeah, that's it. As I mentioned before, I guess if you've been managing your cash flows sensibly, then they won't really have as much impact on you in terms of securing that type of loan. So as you know, I track the monthly figures that APRA puts out. So one of its caps was on investment credit in the banks. So 10% per annum growth was the limit that was imposed by APRA. Well, none of the banks are anywhere close to that now. At least none of the major banks are, and some of them are actually in negative territory. So there's an awful lot of headroom should banks want to start lending to investors again. Interest-only loans, well, we don't know what's going on behind the scenes, but I suspect APRA is probably keen to keep a lid on that type of lending. It would be a bit counterintuitive to see it suddenly sort of take off again. So APRA's cap on interest-only lending was at 30% of the new mortgage flow, but those loans are now tracking at about 15%. So there's plenty of headroom now for banks potentially to start lending more against interest-only products, although we don't always know what's going on behind the scenes.
Well, in light of all this, I want to come back to the question I posed right at the beginning of our chat. How have you changed your investment strategy to deal with these changes, and what do you see ahead?
Well, I know you always have this saying that real estate investment is a game of finance with houses in the middle. So I would say looking forward, you just need to potentially be a bit smarter about how you manage your personal finances. In the good old days, you could just redraw equity whenever we felt like it, buy a new car, buy another couple of investment properties, no questions asked. Well, that's changed, and lenders will be much keener now to assess overall debt and serviceability. And this has impacted me personally in recent years. So I've had to make a few changes. So in terms of changing strategy, well, ways that you can increase your income are good. If you can keep expenses and particularly credit card balances under control, that's a good thing. Sometimes being a renter can be beneficial for those people early on in their journey, growing a portfolio.
So you're talking about the concept of reinvesting there, Pete. If you can't afford to own a property in a good market where you want to live, rent where you want to live but can't afford to, and buy an investment in a good location. Would that be right?
Yeah, that's it. So it's definitely a strategy, I think, particularly suitable to younger people, because you can grow your portfolio of investment properties quicker. But also you don't know when you're younger, where is your next job going to be, in the same city or even the same country? So being a renter can make a lot of sense. Now, I guess I'm rapidly approaching middle age, so the circumstances change. So for me, owning a home going forward is going to be the right thing because I have a young family, as you know. But I think for people looking to grow a portfolio quicker, in terms of bank serviceability, that can actually be an advantage in some circumstances.
Sure, that makes a lot of sense. And I know a lot of people are doing that. I also like the concept of adding value, and I know you do as well.
Yeah, I think that's a key point. If the amount of debt that you can get your hands on at any given point in time is capped, I would say if you can find properties that you can add value to, well, that's what we used to call equity on ice. So it's an option to do something without necessarily relying on bank financing. So looking for ways or older types of properties that you can add value to is a great way to just amend your strategy slightly. Now, I guess that there was an old rule that we used to have that said, you never sell a property because it's an appreciating asset. I would say, well, that rule's probably changed a bit, and potentially now it is a good time to sell a dud investment if you have one, because now that could just be a drag on your portfolio. If you're wasting serviceability on underperforming properties in poor locations, well, now might be a good time to offload those. And sometimes it can even make sense now to pay down debt if the mortgage rate is low enough, but that's really something to look at on a case-by-case basis.
I agree with you. A lot of people think my philosophy is buy and never sell, and that's not really true. It is actually buy and seldom sell. You don't buy to trade. You don't buy with the intention of selling. But sometimes markets have changed, or you make a mistake and you've got an underperforming property. And my philosophy is if you can only own 4 or 5, 6 properties, you should own the best ones you can. But people say to me, it's not costing me money. And they've missed the point. It's costing them the opportunity cost. There's no doubt that there is a cost in selling. There's an agent's cost, and there's sometimes capital gains tax, even though some people haven't even made any money. And then there's the buying costs as well. So I know when our clients sit with us, we have a calculator and run through it with them and see. And often they've got to take a step back or two. But if you believe you're going to get a couple of percent better capital growth in the future, it's often worth taking the hit now. And this isn't a bad time to do it, to get set for the next stage of the cycle. So, Pete, I fully agree with your concept of selling underperforming investment properties. And sometimes it's hard for you to pick. So it's worth sitting with an unbiased advisor because, Pete, I've had a lot of people are subjective. They spend so much time and effort and emotion buying their property that they can't see how poorly it's performing. What's that called? Confirmation bias, isn't it?
Yeah, that's right. So, well, you've mentioned some key sort of points there. Opportunity costs, so what you might be doing with the money instead. Confirmation bias. We all like to think that we're very smart, and most of us are, of course. But occasionally we get emotionally involved, and I'll just throw another idea in there. What we used to call the sunk cost fallacy. So we often, if we've spent a lot of time and effort buying a property, or building a portfolio, and it does take time and effort to do all the paperwork, to do the purchase and so on. We tend to have this feeling that, hey, we've sunk a lot of time and effort into that, and we should keep at it and just stick at what we're doing. But sometimes circumstances change, and if that happens, then it's fine to change course.
Right. Okay. We were running through the various strategies in this changing finance climate. Anything else you'd like to add?
Yeah, I guess just one other thought for people to consider is that the end game might be slightly different now in the current environment. If it's harder for some people to withdraw equity as and when they need it, you might have a slightly different end game. I would say be a little bit careful with what's happening in the share market, though, because Bill Shorten's got a few ideas on franking credits that might be a sign of things to come. But my view has always been that the end game, while you're investing and while you're growing your portfolio, that's probably it's not the most important thing. The most important thing is to actually build a big enough pool of equity that you've got all the choices in the world. I think worrying about what might or might not happen when you retire can be a lot of time not well spent. The most important thing is to give yourself those choices in the first place.
I agree with you. So the concept of living off equity, which is something I've been very comfortable suggesting, is much, much harder today because you've got to prove serviceability. You always had to, but today you're going to have to prove it more by having lower loan to value ratios. But who knows what the rules are going to be in 5 or 10 or 15 years. So I concur with you, Pete, that step one is grow your asset base. And once you've got an asset base, transition to the next stage of lowering your loan to value ratios. And then you're going to have some choices, whether you lower them enough to live off cash flow, you lower them enough to be able to refinance some equity. But if you don't have an asset base, if you only have a little bit of cash flow coming out of secondary properties, you really don't have the same level of choices, do you, Pete?
No, that's it. And let's be honest, the politicians, the regulators, they don't even know what the rules are going to be in 2 years' time, let alone in 10 or 15 years' time. So it's good to be well prepared. But as you said, the most important thing is to build your equity base, build your net worth, and then the choices, you will have choices at the end. But that's the most important thing.
So bringing it right back to the beginning of our conversation, the last couple of years have been different in finance, but if you actually think about it, the fundamentals you and I have discussed are really no different to when you started investing 20 years ago and when I started investing 40 years ago, that the concept really is you get good assets over not only just property. I know you also believe in shares, and for some people it'll be businesses. Over time, build a substantial asset base that's going to give you a level of choices in life, and along the way have the right finance and the right ownership structures in place to make sure you can ride the ups and downs. Because just like the last couple of years have brought lots of changes with all the news at the moment about franking credits and removing negative gearing and dirty, greedy property investors. Boy, there's going to be some changes ahead we're not even aware of, aren't there, Pete?
That's right. I mean, one of the things that one of the few advantages of being an Englishman is that I've lived through some quite serious recessions over my adult life, and even I can remember back in my teens. But one of the things that has taught me is that if you focus on a proven strategy and have good quality assets, that can give you a heck of a lot of peace of mind when everyone's talking about, it's the end of property price growth, it's the end of nobody can build wealth that way anymore. I've been through so many mini cycles and recessions in Britain, and All I've seen throughout that entire period is that some assets will continue to do really well. We've seen that in London and Cambridge and other markets in the southeast of England. Other markets will get badly burned in downturns. Just owning the right type of asset and quality assets just gives you great peace of mind when you get the ups and downs through the cycles.
And that's very different to owning many assets. So we see lots of people say, I want to buy 10 properties in 10 years or 7 properties in 7 minutes. I'd rather you own 1 or 2 good properties because the stability of those is going to give you the peace of mind and the ability to sleep at night rather than the volatility of the less sound residential real estate assets. Pete, thank you so much. Now, if people want to follow you, I know that you regularly have your blogs on Property Update, but you're also at Pete Wargent at blogspot.com, and you've now got your own website as well where a lot of your blogs are. So how do people follow you there?
Just my name, petewargent.com. Lots of different ideas out there, some property analysis and some self-improvement in there as well.
Well, that's one of the sites I look at and read every day as well. So thanks a lot, Pete, and I look forward to having you on the Michael Yardney podcast again real soon.
Pleasure. It's always good fun.
Well, that's it for another show. Thank you for joining me. I hope you got some benefit as Pete and I had a bit of a chat about how we see the property markets evolving, how the changes of finance and the new stage of the cycle are going to affect which properties are going to perform better than others. And I really look forward to catching up with you again this time next week as we discuss more ways of becoming successful as a property investor and in all areas of our life and being a bit better with money.
Thanks for listening to this week's episode of the Michael Yardney podcast, which was brought to you by Metropole, who help their clients grow, protect and pass on their wealth through strategic property advice. If you got value from listening to this podcast, please leave us a review and we'll read it out on a future show. Just go to michaelyardneypodcast.com/review and it will take you over to iTunes where you can enter a review and let us know what you think. We'd really appreciate it. If you don't already subscribe on iTunes or on your Android phone, you'll find us there as Michael Yardney Podcast. If you'd like to gain instant access to the show notes or a transcript of the show, head across to michaelyardneypodcast.com. Watch out for our show next week. You'll learn some new ideas about property investment, success and money in around 20 minutes.